Hello everyone, today is January 28th and this is our session number 4 of the Waikif trading course. Just FYI, I am sick, I'm not feeling well, so I do not know how long I can go on with the class. Maybe, I'll feel that as I start talking more, it kind of comes back to me and I have more energy. I'm totally on drugs right now, so hopefully that will just carry me through the class. If we can't finish, at least 2 hours or 2.5 hours, then, I'll just find some time to extend other classes and we'll just compensate for the lost time like that. All right, having said this, I'm excited to be here. I went through your homeworks again, just because I've been feeling so bad, especially today and throughout the whole weekend. I looked at your homeworks, so I opened all of them. I have not answered all of you. So that's kind of like, what's going on. Um, my overall impression of the homework was that we're definitely on a good path. There are some of the mistakes that are common mistakes. We'll talk about this as we review the distribution homework. Hopefully we'll start it today, if not next week. But I've noticed one thing. There is definitely a trend of improvement that's happening for the whole group. So, that's what is so good and exciting, that, I see how the boundaries are much better. I see how the labeling is much better. So we're definitely doing a lot of good things. All right, next session, February 4th in a week. What will we be discussing? Let's just go to the outline right away. So today, we're still going to review the homework from last week on Home Depot, and I will try to go a little bit faster. Maybe we will not have the volunteers for that. Maybe we'll have some volunteers for the distribution labeling. So we'll try to cover as much as possible. And then still to cover, actually, we've covered phase boundaries, right? So we've covered phase boundaries, we've covered phase C identification. I think, yes, so all of this, sprints and shakeouts, signs of strength, upslope and downslope and trading range, those are going to be discussed. Distribution, and then the next homework on Microsoft. So this homework is going to be interesting because this is usually the time when I'll let you guys do the homework, you send it to me, but then I give you the homework as slides, not necessarily we're going to discuss it in the classroom. And then next session, we're going to finish our price structural analysis. This is going to be the final session on price structural analysis. That doesn't mean that we will not use it in other months. We're still going to we're still going to use price structural analysis so much during our supply and demand sessions. And so session number 5 will be the last one on the price structural analysis. Okay, let's come back. All right, as usual, all of our discussions are for educational purposes only. And we're going to start with the Q&A, just one question, or rather one slide. And this slide and question comes from Justin. And by the way, guys, if you have in your mind some kind of like question like, well, why are we discussing this particular question? Well, first of all, because I've picked it. Secondly, I see value of this discussion right now because we're discussing the price structural analysis. That's number one, so we could go through that. And then it definitely, has that feel of the current market, so it's great. Some of you are sending me requests of look at the chart and comment. So usually this is not the class to do this. I mean, like, unless you're right on the money with the material that we are going through, then I might consider this. My suggestion, and we have such a beautiful venue to do this, to go through the analysis of stocks that are like last boss stocks, right? It's the Wednesday class, Wyckoff market discussion class. So you could submit your chart there, and Bruce and I will discuss it together. Obviously, I can't do it every time, every session. You really, really would have to sign up for the class, meaning that you'll have to be a member of that class. But once in a while, I'll let you guys in, and we do this once a semester. At the end of the whole cycle, I'll invite you for one of those sessions. All right, so let's come back to this slide, and we're looking at Home Depot. Home Depot again. So a few questions here. In accumulation, does backing up action happen on lower volume all of the time? So that's question number one. And if it does, is that where you want to enter a position? Second question, do sprints LPS always happen on reversal candle or hammer, right? And then the last question in the diagram below, it looks like the circle of a major sign of weakness. But then it continues upward, backward, back into the trading range, forming a higher low. Does that make this circle a sprint instead? So very good questions, Justin, and let's address those one by one. So backing up action, does it always happen on low volume? No, it doesn't have to be on the low volume. The volume could increase. Imagine the volume signature like this, right in this area right here. So what would it mean? How would you interpret this? Well, we would be thinking that with the volume increase, there is a lot of institutional participation, right? There is a lot of exchange of shares. How do we know the bias of institutional participation here? What do you think, guys? Well, we have to look at the price, right? So we know that they would be there with increased volume signature. But we need to look at the price to see what that signature actually does, what that effort actually does. Does it push the price below the area of the support into the low, or does the price has the ability to stay up in this area? And it seems to me that it's holding up. It's it doesn't go down. Today was kind of like a day like this. And that suggests that there is on the higher volume signature that institutions are present, but they're buyers. They're absorbing whatever supply is coming with that big volume signature. Now, in reality, it's different, right? It's a different volume signature. So we see how supply increases and then how supply starts to decrease. So we have a decrease of the supply into the backing up action. So not necessarily that we have to have a low volume signature, it's preferable. But then if we do have a high volume signature, then we need to look at the result. In both cases, the result is actually good. And we would be actually thinking here that we are in some kind of downslope information where where we have the commitment above the sloping resistance as a sign of strength, and then a backing up action that backs up exactly into the area of the support that acted before as the resistance. And look how all of these 4 points are working very nicely. Then let's go right away into the question about a sign of weakness or a spring. So I would approach it from two different perspectives. The first one is as we are looking at what has happened recently. So for instance, what has happened in this area. We're seeing that there is a very substantial rally that is much better than the rallies that we've seen before in this trading range. So that tells us that there is some kind of change of character that is happening. And then we're seeing the reaction that is not the same as the ones that we've seen in the trading range. So that's also a confirmation of that change of character. Change of character from what? Well, we've been in the downtrending environment, even with lower highs and lower lows going into a potential sprint. We're still in the downtrend by the definition, although this looks already as a consolidation. So this change of character on the way out, and the character of this change of character, right? Best rally and then very shallow reaction suggests that the bias is actually to the upside. And if the bias is to the upside and we look at the area of the support and we see the price just temporarily committing below, then this is most likely a sprint and not a sign of weakness. A sign of weakness here, I think, could be a sprint could be confused for the sign of weakness here if we look at the horizontal structure. Because the commitment below is quite significant. There are 1, 2, 3 closes below the area of the support, actually, the support cluster here. So that view might be actually not the most favorable. I would still use these lows and highs to connect them together and look at how the price commits just temporarily at the end of this move. Maybe there are 2 closes, but there is definitely one that commits significantly, and then everything else is on the upside. Also, for the bias, we kind of see this area, which is very interesting. It's an increasing upspread, and also we see how momentum increases behind it, and it pushes the price so quickly to the upside. Velocity starts to increase. So those could be the elements of either significant deterioration of the supply or some buying behind it. And in this case, I think that majority of the buying has been done here, here, and even on the way down here. Because institutions don't function like us, retail traders. They're always thinking about the value and liquidity opportunities to get into the position. So it seems to me that this is where the value zone is, right here. Here we're seeing all this buying, and then as the price goes below the value zone, it becomes extreme value. And this is just my view for the whole market. It's from the extreme value in the cycle where we're still in the technically in the still long-term uptrend cycle, right, since 2009 lows. So until we break the lows that were created in December, we're still going to be thinking about that. So think for a second that the long-term bias is up. So what does this quick decline means for the market and this particular stock? Well, it means that short-term we had some kind of shakeout type of action, and then the shakeout creates that extreme value that is very attractive to institutions. Another way of looking at this is just looking at the overall signature here, volume signature. It definitely increased over what? Well, over this whole period right here. So there is some buying in this area, and that's why I'm thinking it's actually, to the upside. Do sprints LPS always happen on the reversal candle? For example, hammer. There are so many ways how that could happen. You could have a hammer, you could have just the bar that's gonna close the bodies of the previous bar. There are so many ways of how reversal could happen. We will be studying that later on in the 4th months. Philip is asking, what is the angle of the price movement that is interpreted as uptrend, downtrend instead of the trading range? I think this is a really good question because that's something that produces that possible mistakes. I've seen people showing me something like this where it is clearly an uptrend, and yet they would start labeling it like this: phase A, phase B, phase C, and something like this. This is definitely not correct. Definitely not correct. So I'm not sure about the angle though, right? So Philip is asking about the angle. But what I'm pretty much sure is that the way how the structure unfolds. Look at the character of the down move right here. What do we see on the opposite side of this reaction? All of the counter move are very, very mediocre. There is no lift in those. So it just tells us that the sellers still persist and that the buyers cannot have a good, meaningful rally. And it only comes here on the automatic rally, which becomes a change of character right away. So you know that the change of character is going to suggest a trading range, a consolidation. And then once you start seeing lower highs and lower lows, that's when you try to connect them and see if it would make sense to see the price deviate around the mean. And if you could see that, then it's definitely a trading range. And it's a downsloping range because of the lower highs and lower lows. But I wouldn't be thinking necessarily in terms of the angle. I would be thinking in terms of how does the trading range starts. Okay, great. Well, Justin, thank you. All right, let's come back to our homework. All right, and the next slide here, we have 3 trading ranges. Yeah, let's have a volunteer. I just feel like I need a little bit of a break. So say yes, I'll unmute you. Okay. Hi, Rama.
Hi, Roman.
Yeah. Rama? Is it Rama, right?
RAMA, yeah.
Yeah, okay, great. Okay, so let's start with the first trading range. So what catches your eye? Actually, no. Let's stop here for a second. Let's start with the different question. What is it? Is it an accumulation or a reaccumulation?
It's a reaccumulation. The first,
Why is it a reaccumulation?
there is a preceding uptrend.
Yes. So we have a move to the upside, consolidation, trading range, and then the resumption of this trend. So it's a reaccumulation, not accumulation. Okay, great. So what catches your eye the most in this formation?
It's the buying climax followed by a deep automatic reaction. And later, the next is the secondary test that happens after that. Yeah. And followed, and that completes the phase A.
Mm-hmm. Okay, so let's talk about this. So there are quite a few concepts here that we could discuss. So it seems to me that the buying climax is defined correctly, right? Because we're seeing some kind of
Accelerate.
climactic run, with the increased spread, and that definitely defines the boundary of the trading range. The alternative labeling to this could be this whole area being a buying climax trading range. I would understand that, so that's fine as well. The conventional probably would be preliminary supply, buying climax, and then look what happens next. What does this remind you of, the next price action to the downside?
The next price action to the downside is I would consider that as an automatic reaction.
Of course, yes, and that would be a very conventional label here.
Okay. Yeah.
As we know, but in terms of the character with which the price goes down, I mean, look at how it goes down. First of all, there is
Right.
not a lot of the distributional pattern here at the top, unless we're considering this whole pattern here.
Right.
So look at this spread, increasing spread that goes throughout so many closes in this area. That's number one. And then secondly, look at the gap the next day.
Yeah. And I think that the whole price action reminds me of a climactic action.
Yes. So climactic action.
Yeah.
And climactic action usually is going to be associated with two things. Either climax itself, so in this case, selling climax.
Selling climax, yeah.
Or a shakeout.
Yeah.
Right? So
yeah. I mean, I would say that it's a climactic action, very much in association with selling climax.
Okay, so let's say that this is a selling climax. Then what would the labeling be after that?
After that, the price is expected to go and test the area where the resistance is established. That is, the testing the buying climax, the area near the buying.
But think about this. We're discussing a selling climax, climactic action, or a shakeout. Right? So either labeling would be okay here.
Yeah.
What should happen after the selling climax? Not the test. We are in the downtrend. If we experienced a selling climax, then we are in the downtrend.
Right.
Where is this downtrend? Well, it's this whole move to the downside. So what happens next?
The next, it goes into the trading range.
Yes.
And from there is a rally.
How would we label the first rally of the low of the selling climax?
That would be labeled as an automatic reaction.
Automatic rally in the accumulation.
Okay,
and then the next reaction would be labeled as?
Secondary test.
Which is testing what?
Testing the area of selling climax.
Okay, so that's exactly what is happening here.
Yeah.
Why do we say that this is an automatic rally? Well, look at the quality of the rally. What does this tell you? Relative to the downtrend, it's a change of character.
Right.
It's the largest reaction to the upside since the buying climax. So of course, this is going to be a change of character, and therefore it could be labeled as an automatic rally. Then look at the next reaction. How does it look to you? Diminishing spread, diminishing volume signature, stopping here at the higher low. So that looks like a test.
Right.
So therefore, this is a secondary test of the climactic action itself. So therefore, our labeling could be like this: shakeout, automatic rally, change of character, and then secondary test. And here is our phase A.
Right.
Okay, so what's next that catches your eye?
The next significant is the rally that goes up to the level of the resistance, and that has a character of essentially upthrust.
Okay. So it's an upthrust action, just because we know that this is a reaccumulation.
Sure.
So we'll label this as
upthrust action.
Upthrust action. Which phase is that?
Phase B.
In phase B. Okay, well, we defined that. What's the next thing that catches your eye? Or rather, let's do this. Where is our phase C?
The phase C is right towards the area preceding the March, and phase C, this is the area where immediately preceding the March. Yeah.
Okay, something like this?
Yeah.
Okay, yeah. So we could have kind of like a small argument here, what phase C is. Remember,
I would mark it even closer somewhere around, yeah.
Okay.
Yeah.
So one of the things that, we've talked about, guys, last time is looking at different phases and trying to define the kind of like the structures within those phases, right? So for instance, this is one structure. It belongs to phase A. This is the test of another structure, and it has a structure of its own. It's phase B. And then it seems to me that all of these reactions here kind of belong to the next structure.
Right.
So, and that's how we want to define phases, right? So we want to say that this is our phase C, and then everything in between is B, and this is our first test, right? So test number one, test number two, and then this whole area right here is just more complex, so that becomes our test number three, and therefore a potential phase C. I don't mind labeling it differently, right? So my first labeling was somewhere here, and I think on my slide, that's how it is. But I would be just paying more attention to the texture of the structure within each of the phases. So then what we have here is a buy-in climax, shakeout, automatic rally, secondary test, phase A. What is the intention behind phase A, really quick?
A change of character.
Stop in action?
Stopping that. Yeah.
Yes, so we're stopping the previous trend. Then let's say if this is phase C, what's the intention behind phase C?
Phase C is the marks the commencement of the next uptrend.
That's not the intention, though. What is the intention behind phase C?
Phase C again marks the change of character as the price gets out of the trading.
That's not the intention of phase C. What is the intention behind phase C? What does it do? If this is to stop, if phase A is to stop the previous move, then phase C is going to be our final test of supply at the support level. So I want you to remember this by heart. Okay, so what's the intention behind phase B?
Phase B essentially shows multiple areas of tests, and testing the resistance to the upside and testing the support to the downside.
Okay, well, Rama, I want you to come back to schematics, right? Because I put there the intentions for each phases intentionally.
Okay.
And I want you to remember those intentions. So phase B intention is to define the relationship between supply and demand.
Yeah.
And then sometimes I kind of like think about this like a war zone. It's going to be extremely volatile as a zone by itself. And then another intention behind phase B is to build a course. So those are the intentions behind phase B. Okay, so where is our phase D?
Phase D follows the last point of supply, precedes the last point of supply, and then as the price moves out of the trading range. Yeah.
So the last point of support, just because we are in the reaccumulation.
Support. Yeah.
Okay. Okay, so give me the timestamp for phase D.
Phase D would be just beyond the second line you've drawn to mark the phase C. That's just after the beginning of the March.
And where is the boundary for that phase D? Let's say the boundary between D and E.
The boundary between D and E would be where your pointer is situated, right there, as is.
Okay.
Yeah. Yeah.
All right. And what is the intention behind phase D?
It's the phase D marks the beginning of the uptrend as the price exit the trading range.
Okay, so it's a markup in the trading range. It's
trading
just
range.
this is a little bit different structure where we see an apex formation. So apex formations are going to have different phases D.
Yeah.
Okay, great. Okay, let's go and look at the excuse me. Look at the distribution range. So what catches your eye there?
It's an upsloping trading range. That's the first feature that strikes me.
Mhm.
And after that is the buying climax. From the price action, I could see
What is the timestamp for buying climb?
Just after May. There are between May and June, there is a market acceleration of the price, and it's almost a vertical parabolic rise.
Mhm.
So that's where the buying climax, I mean, it leads up to the buying climax, and followed by a small pullback, which
Label everything for me. Do not describe what you see because we see the chart. We
right,
understand what's happening. I
yeah,
want you to give me like short answers on the label, right? So if this is the buying climax, then the next point, I want you to label all of these points right here.
okay. The next point would be the uh, automatic reaction,
Mm-hmm. Okay.
followed by the secondary test,
Okay. Phase.
A,
Okay.
and then followed by phase B, where the price comes and tests. Uh, I could see two small tests.
Okay. We see that too. So
Yeah,
another
yeah,
secondary area of the secondary test.
test.
What? Okay. So where is our phase C?
Phase C is the point you marked last. The phase C, yeah.
Okay, so how would we label phase C here? You know, this attempt to overcome the previous resistance.
I, I would label that as an upthrust. Yeah,
Upthrust, and because this is a distribution, so
upthrust action. Yeah,
upthrust after
distribution.
distribution. Okay, we want to check on all of the phases. So phase A, phase B, and phase C. We want phase B to be, you know, the largest, and it seems like it's almost there. It's almost there on
Right.
that.
Yeah.
Okay, so what comes after phase C?
Phase D,
Okay, and
which
specifically with the, you know, I see that
the
the price drops down to this level right here. How would we label this?
right, a major sign of weakness.
Okay, followed by,
Uh, the last point of supply.
mhm, that comes exactly, guys, look at that. It comes exactly to the
Yeah,
point of the resistance, which acted before as a support.
right.
So therefore, you know, this upsloping labeling makes a lot of sense because all of the concepts are fall into the upsloping structure.
Mm.
Okay, great. Okay, Rama, any questions?
Yeah. I think the intentions,
Mhm.
the point you made about intention is well taken, because I think that's something that I'm working on.
Yeah.
To
Mhm.
Yeah,
Yeah, so just
yeah,
you know, go to the schematics, go to those slides with the schematic in the description, and there you can find all of the characteristics for all of the elements, which I think that you're doing fine with. I think maybe
yeah,
just intentions a little bit just to freshen up,
yeah,
and then obviously, you know, we want the label in here, right? So
hmm,
sometimes I feel like students go into the description, and my goal is always, you know, to stop them because we could
hmm,
see the chart. Yeah, we see the chart.
hmm,
But what we're interested in is how do you see the labeling? How do you see the structure?
right.
So yeah, just you know, brush up on the intentions and everything else is fine.
Okay. And in the first trading range, one of the things I
Hmm.
noticed is that the of the three lows between February and March, the third one is a higher low, right?
The second one is, yeah, the second one is kind of like on the same level. Okay.
Right, right. So is it reasonable to mark that as the center the phase C around that higher low?
You know, if you label it like this, like you originally labeled it, I'm
Right.
totally fine, because phase
Yeah.
C in the reaccumulation especially would suggest that you have to come in right here
Right.
on this bar, right here on this bar, and initiate the position, right? So this is your point
Yeah.
of entry number one,
Right.
point of entry number two. So
Right.
from this perspective, from the trading perspective,
Yeah.
does it really matter how we label
No.
it? Probably no.
No.
As long as you
Right.
could understand that
Yeah.
this is a part of the potential phase C, therefore the beginning of the
Mm-hmm.
potential upswing. And
Okay.
you could definitely define the points of entry here really well.
Mm-hmm.
So it doesn't, at the end, it wouldn't really matter, whether
Okay.
you label it like this, or this. Yeah.
Okay.
Okay,
All right.
sounds good.
Yeah.
Thank you, Rama.
Thank you.
Okay. And then let's look at the last trading range. This one is a little bit difficult, so that's why I'm going to go through this myself. So we are having a downtrend, clearly defined climactic action, clearly defined a change of character in the next rally. It's the largest rally of all of the rallies that we've seen on the downside. So here is our automatic rally. And then we have multiple tests. 1, 2, 3, and then test number 4 on the way down. So it seems to me that this rally right here has the largest rally of them all. And so this looks like one swing. There are some things here that, so therefore, just to conclude the thought, this looks like phase A. In some instances, we would probably say that this looks like a test of the climactic action itself as well. But let's just go with this labeling, phase A. So then the next test, which is the second test, happens in phase B. And then the next test, somewhere in this area, number 3, that seems to be phase C. So I think I would definitely accept this type of labeling with kind of like one exception, is that it seems that phase A is somewhat larger than phase B. And in some instances, guys, unfortunately, it's not going to work out like this, right? So sometimes the labeling is just going to be a little bit out of the out of our usual rule interpretation. And hopefully, you could think of the trading value here rather than more of the labeling style. Um, in some instances, we could label it like this, and then that would extend phase B. But again, for trading purposes, you probably wouldn't care that much. Actually, to be completely frank with you, I still would be thinking that we are in phase B at this point. And I would be thinking that we're going to go and experience some kind of phase C. But it doesn't happen. So what do? Well, if you missed this move to the upside, and you are realizing that this could be a sign of strength, then you're waiting for what? You're waiting for the backing up action, which should come where? It should come to the area of the support that acted before as the resistance in phases A and B. So out of this touch and on the reversal, that's when you might be thinking, wow, if this shows me that this is a point of entry, we might have concluded already all of the phases here, and this is phase D, and therefore, I should go into this position. Granted, you're opening the position much higher than, let's say, in phase C, and that still acts as a reaccumulation range for us. But sometimes it's going to be hard to define those phases, and there is nothing wrong about this. It's just a skill building, and sometimes structures develop in a very weird way. So you have to rely on concepts. And what are the concepts here? Well, here is one. Here's this move to the upside that commits significantly to the upside, has multiple closes up, and then spends so much time above. What does that sound like? Well, it's a sign of strength. And then a reaction right into the support. What does that sound like? A backing up action. If this is true, then this is phase D. And therefore, everything before that was phase A, B, and C. Okay, let's have a look at how I label it. Okay, so I put phase A here at this test. I'm thinking that still, this is phase A right here. But let's just leave it as is. Okay, let's see what kind of questions we have. Why is the triggering range not defined by the lowest point of the automatic reaction? So we're talking about this triggering range right here. So, well, we could label this as an automatic reaction, secondary test, and you could definitely have the boundary at this level. Does it come handy after this? Not at all. And we're looking at the chart that has already unfolded. So it's a historical chart, right? So we already know that the price only tests this area right here and not this one. And this leads to the conclusion. This leads us to the conclusion that this was an extreme oversold condition. In the extreme oversold condition, price usually does not have a significant test at the same level. And the testing out of the extreme oversold condition might happen at the higher level. So therefore, what's the use of having this line if the price does not go there? Only when it goes there, you could just incorporate here. What's more important, a secondary test low is being tested again in phase B and then being tested again in phase C. So that becomes a significant support. Next question. Do we care about daily big bull candle? Okay, Eric, right here, this one. Are we still on this trading range? Okay, no, yes, of course, we do care about that. Okay, Eric, I'm confused. Last look at the trading range at the right. Okay, so which candle are we talking about? You have to give me a timestamp. I mean, there are a lot of big candles here. Okay, while you're thinking about this, 1991, okay, right here. There are multiple big candles here, probably. Okay, let me just unmute you, as I don't kind of see that. Okay, so which candle are we talking about, Eric?
Okay, Roman, do you hear me?
Yes.
Okay, my question is why sign of week sign of week instead of spring, or in the phase C
Yeah,
of
this
the
is
accumulation?
this is a mistake right here. Okay, so if we're talking about phase C, this should be a spring. Oh, I know what happened. Okay, let me just correct this. I think this was a slide that I worked on afterwards, and I defined phase C as this one right here. So this becomes a sign of weakness in B, and then this is phase C. So that makes sense. Okay. Although, this, I don't like that. I don't like the phase A, phase B definition here, but phase C could be something like this, and then that would make it a sign of weakness. Right? Eric? Okay, great.
I mute myself, sorry.
Okay, no worries. Okay, next question. How would we mark the small reaction right after the buying climax in the sloping trading range? Okay, so I think that we're talking about the distributional trading range. Let's look at that. How would we label this small reaction? I don't think that we could label this, or we should label this, right? Because again, think about the swings in the trading range, right? So we need to define labeling based on the beginning and the end of the swing, right? So here's the beginning of the swing. This is the reversal. This is the end of the swing. This is the reversal area. And that would define an automatic reaction. Do we have any reversals in this area? I don't see one. Do you? It has to commit below the low of the significant bar to the last significant bar to the upside. So there is no reversal in this area. So therefore, we could just, say that this is a buying climax. Sometimes I see a labeling like this: buying climax, automatic reaction, secondary test. That doesn't necessarily make sense to me. I would rather label it differently. I would rather take this whole area right here, and I would go into the intraday level, and there I would be thinking, okay, buying climax, then automatic reaction, secondary test, phase B, phase C. And this becomes a distributional structure with the small cause to push the price lower into this low. So that would make sense to me. But it wouldn't make sense to me at all to label this as an automatic reaction. Why? Well, because an automatic reaction should contain a change of character. Is this a change of character? No. This is in line with the previous reaction that we see. A change of character has come right here. So therefore, just based on this is going to be our automatic reaction. All right, next one. Okay, so that we've answered. How to read big down spread candle in early December of 1991. Probably 1990, right? This one right here, that comes from Nilesh. Okay, well, this is just an ending of the major sign of strength, and that's it. That's how we would read it. Obviously, we see that this is the bar that has increased down spread. So that suggests that the volume signature increased here, and therefore supply is coming in. And usually, at this point, we're going to see some kind of short-term overbought condition, which brings mean reversion trade for the professionals. So that's where supply is coming from, the increase of the supply. Okay, next one from Lee. Is the small rally in the middle of December of 1990 making traders to enter prematurely normally? Is there any method that could use to avoid that? Yeah, I think we've talked about this, Lee. Obviously, this breakout is being used in a lot of methodologies to get into the position, and we see this gap that suggests that weak hands are buyers at this point of time. So I'm not going to name the methodologists, but you guys might know what I'm talking about. How to avoid this? Well, if you study Wyckoff structure, you would be thinking of what should come, let's say, after phase C, a major sign of strength. But the major sign of strength is going to be followed by what? By a backing up action. Where would it come to? It usually would come to the area of the support, which acted before as the resistance. So therefore, when you have an urge to open this position right here, and you think that the bias is up, think about the structure. If you think that we are in phase D, then you should be waiting for the backing up action. Another rule of thumb is more to the fact that you want to open your positions after the reaction, not on the breakout. There are only two spots on the breakout where we want to open a breakout position. Number one is right here. This is going to be a sign of strength bar, point of entry. And number two, it's on the breakout of the backing up action. And these two of the entry points, one was defined in the course by SMI. We've talked about this, and then this one is just WTC entry that I've originated for you guys, and it makes a lot of sense to me because at this level, at this breakout level, there is a lot of supply that is already gone. It's absorbed. There is nothing left. Okay, but Lee is actually talking about this situation right here. So we have a move to the downside, and then how would we think about the reversal, right? So it's all in the technique now, Lee. So we know, let's say that we know that this is a major sign of strength. Where should it come to? Should it come to this level? Should it come maybe to this level? So we're still not necessarily close to that area, but let's say that we're not paying attention to that. Then what should we be paying attention to? Well, we need to pay attention to the reversal itself. Was this a reversal? Well, it seems like it is a reversal for maybe bars like this right here. It seems like, yes, we reversed that area right here. But are those significant bars for us to the downside? Probably not. What is the significant bar to the downside? Right here. Have we reversed it with this bar? No. We would have to overcome $2 here and close above to reverse it. So therefore, on this bar, especially the last bar, look at that gap, small spread, diminishing spread after this bar. So that doesn't really act a lot as a confirmation of that reversal. Plus, this bar right here most likely has a volume increase, which suggests an increase of the supply. So you don't want to come into this position on that type of bar. Okay, we'll talk about the reversal more, especially in practicum, but there is no reversal here, but there is a reversal right here. Quite a lot of bars are reversing the last commitment to the downside. Okay. All right, let's go to the next chart. How are we doing? 4 o'clock? Okay. Let's talk about sprints. Originally, Wyckoff did not have a definition of a sprint, if you can believe this. The definition of the sprint was added later on by Bob Evans, who was the apprentice of Wyckoff. When Wyckoff passed in 1934, Bob Evans inherited the Stock Market Institute, and he produced a number of great material points about the methodology. I think, actually Bob Evans was kind of like a godsend to the methodology, for the methodology not to die after the 1930s, 40s, and to continue the studies. And he added a lot to the material. One of the additions was the definition of the sprint. Usually Wyckoff would refer to the sprint action as a shakeout or a terminal shakeout. Bob Evans added the definition of the sprint, but he went even further than this. He gave the definition, he defined different types of sprints. So let's look at those definitions. The first type of a sprint is sprint number 3. This is probably the most favorable sprint, where there is just an attempt or a temporary price commitment below a trading range support level. So we kind of could see here how the price commits to the downside, but it's not substantial. and it happens on relatively low volume signature. So relative to everything that we've seen before, since phase A absorption here in Apple, we see that this is one of the lowest supply signatures, and it only temporarily commits. The next day comes back into the trading range. So this is how sprint number 3 would look like. Sprint number 3, we would buy on the return into the trading range. So by itself, a return into the trading range would be defined as the first point of entry for us. Sprint number 2 is going to have the same principle behind it, but it's going to be associated more with weak hands panic, mini panic rather, where supply signature will increase and therefore the volume signature overall will increase, but it's not necessarily going to be as high in as phase A signature or maybe phase B, shakeout type of actions. It also might have a little bit more profound commitment to the downside with multiple closes to the downside, usually maybe 2, or a more significant penetration of the support. So we could see both from the price and the supply signature that it's more substantial, but yet the effect of the sprint is the same. The price quickly comes back into the trading range, and we see that it was just an attempt to commit to the downside and it failed. So in a way, sprint acts as a failed signal. And I mentioned to you guys before that the failed signal in technical analysis is one of the best signals. Why? Well, because a failed signal usually is going to cause a lot of people, weak hands, on the wrong side of the trade. What do you think they're going to do as the price comes back into the trading range? They're going to try to sell it. They try to close this position, making it a market order to buy, which will push the price through the trading range into the sign of strength. And that's what we see here. And then sprint number 1 is something that I absolutely don't like. I don't think it should be in the methodology, but because it is, it's kind of like a legacy concept, so I kind of have to teach it, but I'm obviously teaching it in my own way, stating that it shouldn't be there. Sprint number 1 is basically a failure of a sprint to materialize and a price breakdown below a trading level support on substantial volume. That creates a sign of weakness in the distribution. So effectively, where sprint number 1 is a sign of weakness in the distribution, and therefore, should we even discuss it here? Probably not. And that's kind of like my thing about sprint number 1. Should not be in the method, should not be discussed as a sprint, should not be discussed as a part of the potential accumulation structure. All right, as usual, this slide is, for your homework. Print it out, put it into your library of slides, study it, look at the examples, try to find sprints somewhere else on other examples. All right, let's go to the next slide. And this one I'll do by myself. This is an easy one, right? So we have a climactic run. Again, look at this reaction and then move to the upside. The question here, well, could we label this as a buying climax, automatic rally, secondary test of that belongs to this whole formation? No, we can't. Why? Well, because this reaction is in line with previous reactions that we've seen before. So therefore, this is not a change of character. And if it's not a change of character, then this is probably just a small distributional pattern that we see that creates the causality to push the price lower into the lows of a true change of character. This is the reaction that is nothing like we've seen before on the way up. So therefore, if this is a change of character, then it's located between the bind climax and automatic reaction. And therefore, we could label this area as a bind climax trading range with the characteristics of the climactic run. And then the first move to the downside, and looking again historically at this picture, I would say that characteristics of this move to the downside with the increasing down spread and increasing volume signature suggest that this is more of the climactic nature. This is more of the shakeout type of nature. So I would label this as a shakeout. The first reaction up, automatic rally. Then look at the test. Decreasing spread, decreasing volume. So that looks like a secondary test. Therefore, phase A. And then we're going into phase B and into phase C. Now, I always ask you guys a question. What do you see? What catches your eye a lot? Well, couple of things that definitely catch my eye. The first one is the move to the downside, the last move to the downside. It reminds me a lot of the initial move to the downside because it has some kind of fear built in. All of the previous reactions, it seems like, yes, the price goes down, but maybe not so much as on the first and the last reaction right here. So also, I'm looking at the character and I see that even though the distance to the downside increases, the down spread is actually decreasing, especially in the second portion of this decline. So these are the possible characteristics of phase C. Okay, well, how do I double check that this is phase C? Well, what comes next after phase C? A sign of strength. And a sign of strength should show us the commitment to the upside. Excuse me, definitionally should go, sign of strength rally should start at the low of phase C, go through this whole trading range, commit to the upside, and then spend some time above this resistance and then back up exactly into the area of the support which acted before as the resistance. We have all of those elements. And if you are not sure whether this is a major sign of strength or a backing up action, then look at the characteristics of the rise to the upside. Obviously, the largest rally, that's number one, but look at the volume increase and specifically demand increase behind this rally. So that looks very constructive, and then the backing up action just confirms. By the way, that question that Justin had at the top of the hour, at the top of the class, could the backing up action only be on the diminishing volume signature, or could we have the increase of the volume signature? Well, here it is, an increase in the volume signature, and the price actually goes down. So we can't open position here until we actually have the test that exhibits structural high or low and exhibits diminishing supply signature right here. So that would be our confirmation. Plus, it comes to the area of the resistance. So just a really, really perfect blend in there. So here is our labeling here. Phase C, A, B, and then phase C would be labeled just because this is not the lowest low. It's a higher low. We label it as the last point of support. Okay. Here's my label, and you could just go through this labeling at home. Okay, let's talk about upsloping and downsloping ranges. So students were asking me, what are the rules as to how you create upsloping, downsloping ranges? I kind of explained to you guys, how I did this on the previous slides. That was my answer to Philip's question, I believe. So let's look really quickly at the bottom chart. And this is a downsloping reaccumulation trading range. So we're seeing the climactic run, and then look at the downtrend. And look at this rally right here. This rally acts as a better rally than anything else. So that's a change of character. At this point of time, you would be thinking we're going to be in the horizontal trading range. And we actually apologies. We actually see how the price finds the support on the next low, tries to rally, but not a lot of good demand. So it starts to go down again, and this is where supply and demand increasing at the same time. But we're still deviating around the mean in the same structure. So now the structure has expanded because of this low. So now we're still in the structure. We still would be thinking horizontal structure. But at the same time, we would be maybe thinking we have lower highs, we have lower lows. This is the scenario where in this type of trading range, with the lower highs, lower lows, we might be considering a downsloping structure. So we would define the lows, 1, 2, and then have this downsloping line, and then we could use significant Wyckoff points to define next lines that we need to use, right? So for instance, this was a very important line. So please note how both the spring or shakeout in phase C has been defined by those lines. That's number one. And how the sign of strength and the backing up action have been defined by these lines. Isn't it more effective from trading point of view to take this trading range as trends? There is a substantial distance travel. If the goal, Philip, is to trade this area right here, then yes, definitely. You would be thinking that this is a definition of the downtrend as lower highs and lower lows unfold. Unfortunately, in the context of a much larger trend, this is just a reaccumulation. And we don't necessarily want to trade to the downside in the reaccumulation. Unless, and just quickly write down, what is your time frame, that you trade. Unless you are very, very short-term oriented trader. So for instance, you are maybe like 2 to 3 days in a position, maybe a week, then you could say, okay, I see that we have, let's say after phase B, we come to the area of the support on the climactic run, then on the retest of that, and then it fails. So here I could initiate the trade with the target zone somewhere here. So then you could trade that. And probably your first target and first exit is going to be somewhere here, and then the second target and second exit is going to be somewhere here. So from that perspective, you could do this. But we're looking at the overall structure, right? So an overall structure dictates that we are actually in the reaccumulation. And if this is a reaccumulation, we're trying to define what kind of range we have. Horizontal does not work that well, but downsloping range works extremely well. In the downsloping, upsloping range, one of the confirmation that this works is in the definition of the sign of strength and sign of weakness. We want to see the overcoming of the resistance in the reaccumulation on the sign of strength rally, and then a backing up action that comes exactly to this area of the support, which acted before as the resistance. The same in the upsloping structure. We would take the low in phase A, connect it either to the low in phase B or phase C, in this case, phase C, and then use the parallel lines that we could project from the automatic reaction and the upthrust action. And if we see that the rally of the lows in phase C overcomes those points of resistance that were created in phases A and B, and the price commits and spends time above that resistance, and then backs down exactly to the area of the support, then we would be thinking that this is a confirmation of the sign of strength, which is being shown to us in the backing up action. So the procedure is the same, right? We're still going to be looking at change of character, defining the trading ranges, and then once we start seeing higher highs, higher lows for the upsloping range, or lower highs, lower lows for the downsloping range, that's when we'll start projecting, different scenarios here for the structure. And again, you could read all of this right here and just go through all of this. It just has more explanation, so something for the homework. All right, let's go to the next chart. Okay, so this one is easy too, so let me just go through this. Kind of reminds me of, well, we've seen this, right? So we've seen this. And here, the same, I think this is the same slide, right? The same trading range. You could use an upsloping structure, but in this case, I'm just using conventional horizontal lines. A downtrend, which leads to the climactic action, well-defined on the last reaction to the downside with the price and the volume increase signature. So that's very evident. Right away, we think what comes next, a change of character or the automatic reaction rally, and then it's being followed by a secondary test. Please note how in all of these instances, secondary tests at the end of the reaction has this decreasing down spread signature and also decreasing volume signature or decreasing supply signature. So that tests the supply level that was at the climactic action, and we could see that on the test, there's really not a lot of supply left. And then a very common upthrust action in phase B, which is being followed by a laborious decline into phase C. And this laborious decline, this is something that we like to see going into phase C. It suggests that weak hands are selling, but strong hands are already buying. And that's why it becomes such a laborious move to the upside. We could see some buying behind the volume signature, and we're still seeing, maybe like a slight deterioration of the supply going into potential phase C. It creates a higher low, which suggests that the downward result is diminishing significantly. And on with that, we're thinking that the bias is going to be to the upside. I would probably put the boundary for phase C somewhere here. Why here? Well, because there are multiple tests in phase B that are being violated in this area. So this is the first time where those tests are happening. So therefore, with the intention behind phase C to test, to produce that final test at the point of the support, we're seeing that the support in phase B is somewhere here. So we're trying to identify the boundaries as that initial test of that support. So therefore, your boundary is going to be there. The next rally is very evident. It commits above any of the levels of the resistance. So therefore, it's a major sign of strength. And then we're seeing, an accumulation range again. Here we would be thinking phase C, sign of strength, LPS, so backing up action at this point. Phase A, phase B, upthrust action. So everything looks to be normal. And then phase D is going to conclude of the larger range is going to be concluded by, phase D of the smaller range. So let's have a look. All right. And what else could we mention here? Okay, so a question from Ronnie. If A is point number 1 and phase C is point number 3, what do you define as point number 2 on slide number 5? Okay, so A is test number, I'm assuming test number 1, Ronnie, right? Test number 1. And then phase C is test number 3. Then where is our test number 2? Well, all of those tests right here in phase B, those are number 2 tests. So again, think in terms of the texture, right? So here is texture number 1 in phase A. Then we have a texture in phase C, which is basically a trading range of its own. We have a sell-in climax, automatic rally, secondary test, up thrust action, and then its own phase C. So this looks like its own formation. And then what remains? Well, it seems like these 3 spots remain. And they look the same. Why? Well, because the reactions to these lows look somewhat the same. They are in the context of the uptrend, short-term uptrend that we see as well, and then belong to the same phase. So this is just a series of multiple tests, a multiple test number 2 in phase B. By the way, guys, think about this. If you are observing this type of the behavior in phase B, what could we conclude about the bias of this formation? Well, it's probably going to be to the upside. Why? Well, look at how the tests in phase B are happening at the higher lows. And because it happens at the higher lows, this is a point of strength. Why is this a point of strength? Well, think about the institutions here, right? So someone's selling, but then someone's coming in and still produces some buys. So institutions are buyers in phase B at higher lows. This suggests strength. And even though phase C actually violates those lows, it just gives us an indication that whatever institutions bought at this point of time on those lows, they are in the vicinity of those large institutions that were biased on the way down right here and here. And by the way, if we would look at the value zone, right? So look at this value zone right here. It's right in this area where we saw some buying before. This becomes just an extreme oversold. And then again, once the price comes back to the value zone, again, we're seeing a lot of buying at the same price. And all of the springs that happen, like this spring right here, below this value zone, happens really fast, commits to the downside, and then recovers fast. So all of the elements of institutional buying at the specific value. Okay, great. Let's talk about the sign of strength. So I've already mentioned it many times today. Sign of strength, the definition of the sign of strength. And this is something that I want you to definitely remember. And a little bit of history as to how this definition come about. So I put here pure Romanism, so this means that it comes from me. The problem with the sign of strength in the methodology was that it was defined as a sign of strength was defined as a sign of strength bar. And usually when I would ask a student to define a sign of strength, they would usually say, well, it's a bar that has an increasing spread to the upside and increasing volume signature. And that was kind of like a definition for the sign of strength. Well, first of all, that's not necessarily a definition of a sign of strength. It could be even or a definition of a sign of strength bar. It's a characteristic. We know that the characteristics of the sign of strength bar are going to be exactly that: increasing upspread and increasing volume signature. But it's not necessarily a definition for a sign of strength rally. So let's look at this. A sign of strength bar is going to be this, right? A bar that is increasing in spread and increasing in the volume signature. This bar does not qualify as a sign of strength rally. A sign of strength rally definition is going to be a rally that travels off the lows in phase C throughout the whole range, that commits above the area of the resistance that was created by phases A and B. So we see that commitment right here. That spends time above that area or in this area, and then that has a backing up action that suggests that comes exactly to the area of the support that acted before as the resistance and was created in phases A and B. And that's the definition of the sign of strength rally. So this I definitely want you to remember, because I will be asking you many times, what is the definition of the sign of strength? What is the definition of the upthrust? And you should remember this by heart. All right. What else? So a big difference between a sign of strength and a sign of rally and a sign of strength bar. So in all of the cases, what we're looking for is the commitment, right? So commitment to the upside, if this is a sign of strength. Off the lows in phase C, through the trading range, commitment to the upside, and then a backing up action that comes exactly to the area of the support that acted before as the resistance. All right, great. Okay, so this one is interesting. So let's have a volunteer. Just say yes, and I'll unmute you. And especially the first trading range. I wonder, guys, how you would be looking at that, how you would define that. Okay, so volunteer. No volunteers? All right, Nilesh, okay, let's go to you. How you doing?
Hi, Raman.
Say again your name so that I would pronounce it correctly.
Nilesh.
Nilesh, okay, great. Okay, so Nilesh, trading range number one, how would we label it? What catches your eye?
So, beginning of the September, right? That seems to me like a selling climax.
Mm-hmm.
There's a price tried to go down, and
Price first goes up.
right.
Yeah, so what is this initial move to the upside then, after the
That
selling
would be
climax?
automatic reaction, and then it's kind of combined in the single bar, I would say. The selling climax as well as the automatic reaction happened kind of on the same day. That's how I think I would
Yes,
interpret that.
yes, that's totally correct. The same day exhibits both selling climax and automatic rally. Okay, so then the next reaction and the next
Mm.
low as a high low could be labeled as,
Secondary test,
and that defines
phase A,
phase A. The intention of phase A is
stopping action,
stopping action. Great. What are we stopping?
the downward movement.
Okay,
Uh,
great. So now that we've stopped that, now we could define the resistance and the support. So we always will start with the horizontal range. And that's my suggestion to all of you. Sometimes, I hear questions as, when do we start, putting the downsloping or upsloping resistance and support? Well, initially, always put the horizontal boundaries first for the range. This is where the majority of the time the price would spend. And then once you start seeing lower lows or higher highs, that's when you could go in and establish, more of the downsloping environment. Okay, so what is next? What catches your eye next in this trading range?
Right. Then in phase B, there are series of secondary tests forming
But is
higher.
this is phase B the most exciting to you as you look at this chart, or are you just going sequentially?
Yeah, I was just going sequentially,
Okay,
but the more
well, yeah. So let's just pay attention to the question itself. What catches your eye, and not necessarily what comes next.
the downward movement, right, which happened around the phase C test, right, around October, right,
Okay.
the rally, yeah, the downward reaction, and then the test that happened around October, that
Okay.
catches my.
So how do we label this whole thing here?
That would be phase C.
Okay, phase C. And how would we label, this price action in phase C?
Spring.
Yeah, could be a spring. Obviously, it has all of those characteristics of the spring, where there is an attempt to commit and then the recovery, quick recovery. My only hesitation here is the volume signature. So such a big increase in the volume signature. So this also could suggest that it could be labeled also as a potential shakeout. Especially if you're using the horizontal range, then somebody might say like, yeah, I see a lot of volume, I see a lot of penetration below the support area. I think spring is better here at this spot, just because we don't see big commitments to the downside in this phase C. All right, so if this is a spring or a shakeout, then what comes next after after this phase C?
Sign of strength rally.
Okay.
Yeah, that's the one. And then we have a backing up action.
Okay, great. And then everything in between C and A is B. And this attempt to overcome the resistance and commit to the upside with the return into the trading range, we would label as
Upthrust in phase B.
upthrust action in phase B. Okay, great. So, and here is our whole labeling. One of the things here was the horizontal range. If we're thinking that this is it, look at the sign of strength, how it comes to the point of the resistance, and it doesn't overcome it. So if you're using the horizontal range, then it's going to be really difficult to contemplate about this at this spot. Why is it failing at the point of the resistance? Is this a sign of weakness by itself, right? That failure. But if you're using a downsloping picture, then downsloping range, then you can clearly see that there is a commitment to the upside. And more importantly, as this commitment develops as a sign of strength rally, there is a backup into the support that acted before as a point of resistance. So that confirms structurally that indeed this was a sign of strength and a backing up action. And therefore this is phase C and this is phase D. And if you missed your entry on this spring, or let's say on the sign of strength bar, then you could definitely enter somewhere here in this area on the smaller backing up action that belongs to this whole range. All right, great. Let's go to the second trading range. And
Sure.
Nilesh, let's start with phase A.
Sure, that would be buying climax where your pointer is, and the downward reaction would be automatic reaction,
Mhm,
and then we have a secondary test.
mhm.
That would be phase A.
Okay.
And then we in phase, okay, then phase B again we are testing the same. There is one upthrust action in phase B that I see, and in phase C is
Where is
the one
phase C?
in August, after August 9, I guess, somewhere around that. Yeah, that's where we are testing the phase B lows for the last time.
Excellent.
Uh,
Mhm.
and that's, yeah, I do see an increase in volume there, but I think the downward spread is lower there, and we do not breach earlier supports as well. So that's a positive sign.
Still high low relative to the lows in phase A.
Right,
Okay.
right. And then we have a sign of strength rally, but which it goes to the buying climax, but not really crossing the upthrust action that we had in phase B until later in October.
Well,
Yeah.
think about the definition of the sign of strength. We said that a sign of strength should rally off the lows in phase C, go through the whole range, commit to the upside. So all of this rallies right here, those are kind of like minor sign of strength, right? So they're still in the trading range. They have not overcome all of these points of the resistance that we have in phases A and B. So therefore, you're looking for the commitment that is above all of the resistance lines. Where is it? Well, somewhere here. You also want to see that the price consolidates, spends time above that first push up, and then comes and backs up exactly to the area of the support that acted before as the resistance. So therefore, a sign of strength in the backing up action is being shown to us here, and therefore they belong to phase D. Okay, great.
I have one quick question. So in this whole structure, right, what would be, as in, where would you think about opening a position? Would it be in buying, backing up action only, or are there any other interesting levels where you see the signs of upward reversal, or you would wait for
Mhm.
this backing up
Okay, so
actions?
in other words, where else? Where would we be opening positions, right? Am I correct? Yeah.
Right.
Okay. All right. Great question. Thank you, Nilesh. And I'm gonna mute you. Okay. So one of the things here right away, and we'll come back to this question in a second. Climactic run is very well defined. So there is a climactic volume here. A climactic volume does not necessarily have to come on the last bar. It has to come on the last rally, though, and be a part of that rally. Um, but we clearly see that there is a momentum move, there is a vertical absorption on the way up, and then there is a climactic run, which is being concluded and followed by a change of character. And I'm looking at the next reaction to the downside, and this looks to me like a test. So I'm starting to think that, could I label it in a slightly different way? Remember how we said that sometimes we could label a reaccumulation as it starts after the backing up action as a shakeout that is being followed just like a regular accumulation labeling, automatic rally and secondary test. So I think this is appropriate here. Buying climax, a shakeout type of action on the increased volume signature, and it doesn't really behaves as a pronounced move to the downside. So right here, even on that, where we see that the distance covered by the rally and then the distance covered by the shakeout are just so different. The shakeout is much smaller than the distance to the upside. So so therefore, and with the volume signature, we're thinking, okay, maybe like temporary shakeout action. If this is a shakeout, then the next thing that we're experiencing is automatic rally, secondary test, phase A. And we kind of see that the texture of phase A is congruent with all of these thoughts that I've just went through, right? So it seems like all of these tests are belong to each other. There's two reactions. The second reaction is just a test of the first reaction. So that suggests phase A. Then we see that in phase C reaction, this is a different texture. This is a different test. And it looks so different than phase A. It also looks different than phase B, because as we look at phase B, this is the texture. It's kind of like this laborious move to the downside where there's selling, 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 and yet there is no way that the price can commit below the lows in phase A. So that's number one. Let's come back to the question by Neil Ash that was about the points of entry. So in my trading, I probably would be thinking that after the upthrust action in phase B, the move to the downside is actually that move into phase C. So I would be thinking of interpreting this trading range, thinking that this is phase C, minor sign of strength, maybe major sign of strength right here and the backing up action. So there's an entry somewhere here. The exit out of this position could be here or on the failure of the support right here. So you probably would be ending up with, just a small win. Small win, break even, small loss. And that would be your trade number one. And again, I'm not shying away out of this type of opportunities, out of this type of trades, because I don't necessarily know 100% that this is going to be phase C. I mean, we could go into much deeper analysis and figure out why it wasn't phase C, but at the same time, we in a lot of cases we just don't see that until it actually happens. Plus, the character of the move to the upside was actually somewhat okay. So therefore, after this first trade, if we're still thinking that this is the bias is to the upside and we're defining phase C on the next reaction, our entry is going to be somewhere here. That's entry number one. Our second entry out of the reversal of the LPS, so that's entry number two. We don't necessarily want to enter somewhere here. Why? Because we don't know if the next reaction is going to be such that would take us out and hit our stop loss. So we would just patiently wait until the backing up action after the sign of strength forms, and we would enter somewhere here. So this would be our third point of entry. So we would be entering here, here, and then here. And prior to that, we entered here, and we exited here and here. All right, let's see some questions. Could you start back in July with buying climax? From Philip. Philip, are we discussing the same trading range? It's probably somewhere here, right? So could we start back with July with buying climax? Okay, yeah, buying climax. So we have a small distribution range that produces the cores for this low. This low here is a trading range by itself. It starts here. So here is selling climax, automatic reaction. Secondary test somewhere here, just hidden. Sign of weakness in phase B. Upthrust in phase C. Everything in between is B. And then a move to the downside. Selling climax, automatic reaction, secondary test, phase A, and so on and so forth. Right? So we didn't go through this structure. We just went into this structure because that was the assignment. But here it is. All right, next question. big volume on a spring is bullish or bearish indicator or none. So I'm still thinking that this is the case. Actually, in both cases, the volume signature increases. Now, we will study this in more details, literally like in a couple of sessions. But and it's so funny how on the same slide we have two different variations. The first variation is kind of like a more normal volume signature where we have an increase of the supply in phase A, and then we have a decrease of the supply into phase B, and then a local increase of the supply from phase B to C, and long-term decrease of the supply from phase A to C, and here from B to C. In the first instance, the volume signature is different. We see that from phase A going into phase C, we actually have an increase in the supply signature. And in both cases, we would be thinking about what? We would be thinking about the result. What is the result of this whole thing? If the supply increases, do we produce a significant commitment to the downside? And we see that there are attempts to commit, but there is no actual commitment below the support area. The same here. There is an attempt to commit, but yet it doesn't. It only sprints below the lows in phase B. So in both cases, result is very crucial for us to identify, and then volume acts more as a confirmation of institutional presence at these spots. And the way how we would be thinking about institutional presence is, well, they are here, so what is happening on this increased volume signature? Well, the price tries to go down to the downside and then recovers, tries to go down and then recovers. So therefore, that volume signature suggests participation of institutions, and what do? They are buyers at this point. So therefore, the bias is to the upside. Good questions today. I wish I would feel better a little bit. And maybe we could just like even go into more explanation on this. Okay, is the first trading range an accumulation? Well, again, you have to think about the context of everything what is happening here. So this acts as a reaccumulation. This acts as a reaccumulation as well. The definition of the reaccumulation: move to the upside, consolidation, move to the upside, consolidation, move to the upside. So both are reaccumulation ranges. Is August 23rd of 1999 also as a sign of strength? This rally right here. Well, we could kind of think that yes, there is definitely like this major sign of strength, commitment to the upside, but I probably would be just thinking that what kind of value it gives us. Probably none. The fact that the trading range, the second trading range, just rests above the buying climax here suggests strength, suggests bias to the upside, but I wouldn't be labeling this whole move as a major sign of strength. I would probably be thinking more about this area right here as a sign of strength in the backing up action. But I kind of see the logic of why you would think so. All right, great. So here's my labeling here. You could go through this as you do your homework. Let's talk about shakeouts and sprint type actions. All right, so we've discussed sprints, and I mentioned to you guys that Waikoff actually did not have a definition of a sprint. What he had is a definition of a shakeout or a terminal shakeout. And a definition of a shakeout is going to be basically a difference between a shakeout and a sprint. So we said that the sprint is either an attempt or a temporary commitment below the support level. Shakeout is much more than that. And I want you just to, on the very simplistic level, to think about the shakeout is it's like a very, very deep spring. So it's a pronounced price commitment below levels of the support. Right? Look at how many closes we have below here. Quite a few. And distance-wise, it traveled. Right? We also would like to see a much better volume signature here. So more of the increase. And the reason why the volume signature here is not that significant is just because it's actually a downsloping range, and I've used this example in the previous slide. So it acts actually more as a spring in the downsloping range than a shakeout. But in the horizontal range, you definitely are going to recognize this as a shakeout. And this would be a more conventional way of thinking about this concept and specifically thinking about this trading range formation. So what's kind of like the confirmation or the tactics for the shakeout? Well, with the shakeout as well as spring number 2, our points of entry are always going to be on the test. Think about this for a second. Why do we need the test for spring number 2 and the shakeout? Well, because both are going to be associated with the increased supply signature. And if supply is increasing, we always want to have some kind of test. And this test always should come as a higher low and on the diminished supply signature. That way it would be a successful test. So where is that test? Well, it's a little bit hidden right here behind these bars. And actually supply does come in again and being observed at the same time. So this acts actually as a very good sign. And we understand why this happens. It just happens before the earnings catalyst. So that's why some volume signature comes, supply comes, there's a lot of hedging before the earnings, and then the price jumps. Okay, let's talk about spring type action. So what is this spring type action? So sometimes I would say, oh, look at this upthrust action, right? So in the reaccumulation, an attempt to commit to the upside with the subsequent failure is going to be labeled as an upthrust action. So it looks like an upthrust, but in the reaccumulation, we know that we usually don't use upthrust as a definition, but it's there. It looks like an upthrust, it acts like an upthrust. It is an upthrust only in the accumulation, so therefore we would say upthrust action. It acts like an upthrust. The same with this spring. We could see in the distributional structure that in some instances a sign of weakness could be interpreted as a spring. It would have the same characteristics where supply is diminishing going into the spring, where the commitment below the support is going to be just temporary and just so perfect how it just sprinted like this and then came back the next day with the gap up. Educators like Gary Fullwood, David Weiss, Gary Dayton, they would be talking about this as a spring, and rightfully so. It is a spring. It acts as a spring. But to be more accurate, let's just define it as a spring type action, just because we know what has happened next. The price went up and then went down. So we're seeing that this is not an accumulation or reaccumulation, and that this is a distribution. And once everything unfolded, we know that this type of action before phase C is going to be a sign of weakness in phase B. So, and therefore, we would just look at this and we would call it a spring type action, which is actually a sign of weakness. All right, let's go to the next segment. By the way, were there any other questions on the on what? No, no, we went through this. Okay, great. Let's talk about distribution. Let's talk about events and distinctions. So we went through accumulation, the definition of accumulation. Actually, guys, let me take like a 1 minute break here at this point, and I'll be back in a second. Hold on a second before we go into this new material. All right, I'm back. So let's start our conversation about a distribution. Um, so what is happening in the distribution? How does sentiment change through this whole trading range? What do institutional hands and weak hands are doing? How do they behave? Well, it's all been, of course, driven by institutional activity. So we are in the uptrend, and then suddenly we reach some kind of point of value for them. And in some instances, this value is going to be defined also as an overbought condition. You're going to have some overthrows in this area in the major uptrend. And this is where this type of condition creates a very bullish weak hands sentiment. And with this very bullish weak hands sentiment, uh, that produces liquidity availability, which basically suggests that institutions could sell into weak hands strength. And in a lot of cases, that selling starts on the way up. And you could sometimes see how the price goes up, stops, goes up, stops, goes up, stops, and then produces a big change of character. So usually these spots are going to be associated with the tremendous increase in the supply. But yet, because this is just initial selling, it's not going to produce a big downward result. And therefore, it's hidden from us like that. And only a trained eye could see that. And we'll definitely go through that, especially in the second month when we will be discussing, supply signature, demand signature. So we'll go through that. But this is the initial place where institutions are gonna unload their position or close out, some of it, scale out. And this area right here will be defined as a buying climax. It doesn't necessarily have to be like a climactic run. It could be even a trading range. There are so many ways of how buying climax could unfold. But buying climax is going to be associated with the first attempts by institutions to sell their position, to distribute into the strength of weak hands. And this is where weak hands are going to be extremely excited. Weak hands are going to be correct on the bias and correct on their timing in the last portion of the uptrend. This is where they're going to enjoy all of the profits to the upside. You hear usually a lot of stories, from weak hands where they're saying like, I made so much money. And that usually happens on the climactic run. Think about 2017, right? The last 2 quarters, from summer to into the January of 2018. That was the market where we had that climactic run, and this is where we heard a lot of the great stories about how big money were made on the way up. Then comes a change of character. That change of character is going to be very, somewhat sudden, because here institutions are selling as well. And now, instead of selling and no downward result, in this case, on the change of character, they will be selling and there will be an increase in the downward result for the first time. And that's what is going to define a change of character. So behavior has changed for the institutions, and not only that, but the price follows now that behavior in the direction of the institutional force. And that's what produces that change of character. A change of character low is going to be defined as an automatic reaction, and that would define the boundary of the trading range. And if anything, this is just such a great concept, I thought, that Wyckoff has come up with. A trading range, future price action, is going to be condensed between the boundaries of the resistance and the support. This is where the majority of the time the price will be between these two lines. Once we define the boundary of the trading range, the next action for us is a retest, a secondary test. Now think about this. At this point of time, at the automatic reaction, there is some kind of short-term value proposition, and because the price went down, as the price goes down, there is some short-term value. Who's going to take this? Who is the buyer here? Well, institutions have been selling into the strength of weak hands. They've been selling on the change of character as well. So would they be buyers? Now, we were taught that, institutions might actually be buyers at this spot. I doubt that strong hands institutions would be buyers at this spot. Why would they be? There is no logic in this whatsoever that they would be buyers here. Only institutions that are weak hands, that are seeing some kind of value for them, they could be buyers. And if it's a reaccumulation zone, then they would, strong institutional hands would be buyers as well. But I don't see how weak hands, institutional hands, would be buyers at the. Strong institutional hands would be buyers on the change of character low in the distributional formation. Their goal and intention at this point is just to scale out, to sell. So no buying by strong hands. So weak hands are going to be buyers here. And that's what's going to lead to this next weak rally, which is going to be a secondary test. And that would conclude phase A. The intention behind phase A is the same in distribution as is in the accumulation. It's to stop. To stop what? To stop the previous move from going further up. So we're stopping an uptrend. And all of the elements, including the preliminary supply, where the first sell-in might come, buy-in climax, automatic reaction, and secondary test are going to be a part of phase A. As weak hands are buying on the way up, imagine what happens to them on the next reaction. They're basically saying, this is probably a wrong position for me to be in. And it's going to get them out of this position, maybe on the sign of weakness, maybe on the secondary test, just because there was a reaction and they were expecting more of the move to the upside. So they would get out of this position, and as they get out, that could produce that sign of weakness that, again, could produce some kind of short-term value. The short-term value could finally be picked up by some of the institutions that are going to be, again, weak hands at this point of time. And that absorption of the supply at this low is going to push into the next high. And as weak hands, and like public weak hands, are not participating in this rally, they are regretting that they did not participate. So what do? On the next reaction, they are coming in here and they are initiating the position. So weak hands buying. And at this point, strong hands are just selling, 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 selling. And they try to sell at the upper boundary of the range. As they were accumulating the stock, the shares, in the lower boundary during accumulation, in the distribution, they will always try to be effective with their selling and to sell at the most optimal price, meaning that that price is going to be sell price is going to be in the upper part of the trading range. And of course, depending on how the market reacts to that selling, right? So if the market still wants the shares, that selling in the upper part of the trading range is very easy for institutions. But if the weak hands are less willing to buy the stock, then most likely it's going to be much harder for institutions to sell in the upper part of the trading range, and they would have to push the price lower. So sometimes weaker structures are going to have, structures like deteriorating structures with the lower highs and lower lows. It's just institutions can't really sell everything right away, so they sell and then they allow the price to go up. Then they sell, the price goes below the low, creates a lower low. So they know that, whatever supply they provided into the market, it tanks the market. So they need to be careful as to how they sell. So next time the rally goes up, they're trying to sell maybe less, and then on the way out, they just capitulate their position and just sell everything. And that produces the gaps on the way out, a big spread. Well, if the weak hands got into this position again, so this is second time when they bought, and they're really enjoying the upthrust, because upthrust is going to have a lot of characteristics of the sign of strength. This is where the spread might be increasing to the upside. There might be increasing volume signature as the rally unfolds. And then as the price commits to the new level, this is the becomes the second point of excitement for weak hands. What is the first level point of excitement? Well, we said that it was a climactic round. These are the two spots where weak hands are going to be excited about their position, so therefore they're going to provide more liquidity to strong hands, institutional hands, to sell into. So we often see that in this area, we're going to see either one bar or several bars with the increased volume signature that suggests the presence of supply. And as it fails, this is the first time where weak hands are going to say, I'm not selling. Why? Why are they not selling at this point? Well, because finally they realize that they have to be disciplined. But unfortunately, they get disciplined at the wrong time. And this whole weak hands, strong hands, weak hands usually defined not just by the incorrect bias. Their actions are defined by incorrect timing as well. And that's kind of like the case here. So they want to be disciplined, and they say, every time, I entered this position, the price went down, and then the price went up. So now that the price goes down, I'm not going to sell this position because I know that the price will go up again, and it will rebound. And it would rebound in the reaccumulation. And unfortunately, if it happens to them in the reaccumulation, imagine the emotional confirmation that they get from that rebound. The rebound is basically just saying, yeah, you should be doing this all the time. And that's how they would be functioning. So at this point of time, they do not give up on their position, whereas institutions are selling into that strength. There is really not a lot of strength, just because not a lot of bias on the last point of supply rally. And the stock or the shares are in weak hands. So therefore, this rally is going to be mostly like flat, or it's just going to produce some kind of momentum to the upside, and then it's just going to come down and then tank. So imagine what weak hands do next. As they hold on to their position and the price goes and breaks below the support, what do you think is going to happen here? Well, at this point of time, there is too much of the emotional pain that weak hands are going to have. And by the way, again, weak hands, not just public, institutions plus public, and institutions on the wrong side of the trade. And when they see that the price goes down, they just basically emotionally capitulate, and they say, get me out at any price. And that's what produces this big move to the downside. Usually, once the price comes out of the distributional formation, we could see a lot of gaps to the downside that are significant gaps. We could see big spread increase to the downside that are going to be extremely big and extremely significant spreads to the downside. And that's where we know that there is a capitulation that is happening on the way down. All right, as in the accumulation, we would be using Wyckoff events to define phases. We've talked about phase A and all of the events there. And it's kind of like a mirror image of the accumulation, right? So we have a preliminary supply instead of preliminary support, buying climax instead of selling climax, automatic reaction instead of automatic rally, and then secondary test is going to be the same. Then the labeling changes. We still would be thinking phase B as the test of the support and the resistance. And if the test at the support is a low, then we're going to label it as secondary test as a sign of weakness in phase B. High-low is going to be just a secondary test, and then excuse me, a lower high in phase B is going to be labeled as an attempt to upthrust. And a higher high is going to be an upthrust. So these are the label and definitions in phase B. And then phase C is going to be our final test of the demand, right? So in the accumulation, final test of the supply, here a final test of the demand in the distribution. And it's also going to have either a higher high, which will be labeled as an upthrust after distribution. Why after distribution? Because if this is a distribution, the thought here in the methodology was that distribution has already happened by that time. By the time the upthrust happens in phase B, distribution is done. This is, again, not necessarily correct. The method requires a lot of corrections and adjustments, and this is what I'm kind of trying to do with this course. It's just to put everything on the correct path. So this excuse me. So distribution still could be happening on the way down, even in phase D. There might be some selling on the way down. Distribution could happen even on the way down in phase E. Institutions can still be in the mode of selling. So to me, this is definitionally not necessarily the best semantic after distribution. I would say that maybe this is an distributional upthrust. That's what I would probably say, like DUT, something like that. Upthrust after distribution could be also be tied with tests or multiple tests that come and tests that attempt to go up. And then a lower high in phase C will be labeled as a last point of supply. And then we are experiencing a change of character. The next reaction is going to be the largest reaction in the trading range, which defines that the behavior has changed, and therefore a change of character is underway. The change of character is going to be confirmed by the last point of supply rally, which usually is going to be weak. And after this rally, this is where the capitulation is going to happen as the price commits to the downside. Intentions behind phases in distribution are the same as in the accumulation. Phase A, as I mentioned, is a stop in action of the uptrend. Phase B is a cause building, and this phase defines the relationship between supply and demand. Phase C is the final test of the demand at the resistance level. Phase D is the initial markdown within the trading range, whereas phase E is going to be in the markdown outside of the trading range. As usual, I'm giving you the definitions and the characteristics of all of the Wyckoff events in the distribution range. This is something that I want you to print out, to have it in your library, and to study as a homework assignment, and obviously to remember those characteristics. And remember this sequence. It's usually when we don't remember the sequence, of all of the labeling events that are happening, this is where we are starting to make mistakes. And this is where I see how the students maybe, not understanding the material. So please make sure that you go through this slide and study and remember characteristics by heart. Okay, let's look at some variations of the distributional patterns. So a conventional distributional trading range would look something like this. where we see a horizontal structure, and we could have maybe some higher high interface C, maybe a lower high, where we would have like a last point of supply type of situation. But predominantly, the price would be consolidating within the boundaries of the support and the resistance that were created by the buying climax and automatic reaction in phase A. A more alternative schematics and labeling could include a leadership, a distribution of the leadership stock or a leadership instrument. It usually is going to be associated with a very unwilling change in sentiment by market participants in this structure. It has been a leader on the way up, and it still could act as a leadership. And the 2018 market in the US is a prime example of that, where we did have a change of character, and yet we had an upthrust into the climactic high. It more reminds us of this schematic right here, which also defines a distribution of the leadership stock, where a buying climax is being followed by a shakeout type of action. Then we have a reaccumulation type of structure that leads us to the upthrust formation, and then we have a downturn. Now in this market, what's kind of like very, very interesting about this market is that as it went down, it recovered really fast. So therefore, what are we thinking here with this recovery? Why did it recover so fast? Well, it only could recover under one condition, where in the oversold condition, we have some kind of value for institutions. If there is some value for the institutions, what does it mean for the bias? Well, the long-term bias, as they see it, is still up. So therefore, I'm thinking that this whole formation that we're in right now, probably just a long-term reaccumulation. And probably this rally will conclude with some kind of reaction and then a consolidation that's going to lead to potentially next move to the upside. This type of scenario could only be negated when we would see maybe a reaction that's going to bring us to the lows, and then the subsequent rallies are going to be so weak that we're just going to collapse, after those. So it's going to be interesting to look at the next reaction, because next reaction is going to define a lot of the structure that's going to come next. But this is something that if you want to hear more on, you could join us for our Wednesday class, Waikaf Market Discussion. So two types of leadership distributional patterns, and then we go into something very, very unique. Both of these patterns, so number 3 and number 5, are of the same family, and they are called TP formations, or TP family. So what is TP by itself? Well, it was taken from the Indian hot look. This is how it looks. So there is a move up, and then there is quick move down, speculation on the way up, and then urgent selling on the way down. Why is it so? Well, because there is just like not even extreme, double extreme overbought condition on the way up. Basically a pure speculation. And you've seen this in the Bitcoin just recently. You've seen this in the Chinese market in 2015. So many other examples that we could observe in this hypodermic formation. And this is the biggest difference between, let's say, hypodermic formation than anything else that we see here on this slide. the phases are going to collapse, and the duration of the phases is going to shorten. So therefore, our phase B is going to be short, and it's going to be in line as phase A and phase C. Usually we would like to see phase B as one of the biggest phases, right? Look at all of the schematics. Phase B is quite substantial. But in the case of the hypodermic distribution, this is where there's going to be collapse in duration for phases. Why does this happen? Well, because of the extreme value that institutions are getting and extreme profitability that they have. They don't want to wait and distribute the stock throughout the horizontal formation and take time to do that. They basically say, get me out now, and I don't care at what price. So they're going to sell, sell, sell on the way down, and they're just going to take the profits, whatever profits they can, and that profit, even on the way down, is going to be substantial. We'll study more of these examples, later on and in the practicum as well. Another TP family member is the loss chart, the loss schematic right here. And it's going to have the same type of institutional behavioral characteristics as the hypodermic distribution. There's going to be some speculation on the way up, but then what's more even important is that throughout the initial phase A and early phase B, we're going to see urgent distribution by institutions. And usually, this urgent distribution will conclude initial selling by institutions. And because of that, the price is going to go into some kind of apex formation. And in this apex formation, this is what's going to happen. Weak hands are going to find some value, and they're going to be buyers. But because they're weak hands, their buying is not going to be very intense, and it will never produce the rally that's going to come to the levels of the buying climax. And this is one of the attributes of this TP apex formation. And institutions, the strong hands, they already sold. They don't need to sell anymore. So they are just basically inactive. So institutions are inactive throughout this whole apex formation. If institutions are inactive, then all of the reactions to the downside, just because they are biased already to the downside, are going to be mediocre as well. And that's what creates the apex. Weak hands are buying at the value zone, and then they're just holding on to the position. And then strong hands are just basically already sold out, and they don't want to sell anymore. So there is an inactivity by institutions, and that produces this apex formation. It is being resolved on the way out, and ironically, this on the way out is also going to be led by institutions. They're going to see that throughout, let's say, a couple of quarters, there is no absolute or relative outperformance, and this will lead for the final capitulation. And they were going to give up on this position. As they're giving up, the supply is going to increase at this spot, and also the price will start moving to the downside. This movement to the downside will change the sentiment of weak hands, and they're going to start selling as well. And that's why apex formations produce such quick moves on high volume signature, is because if there is a capitulation out of the apex formation, everyone participates in that. And they're going to just capitulate on the way down. getting out of the position, and it just collapses the stock, collapses the price. All right, so definitely something that I want you to think about, that I want you to go through. And especially this slide right here with all of the Wyckoff events, all of the phases, intentions behind those, and so on and so forth. Okay, so I think that we're gonna stop. Okay, so a couple of other things. So cheat sheet on the distribution, phases A and B. This is again something that you need to print out and just keep in front of you, keep it in your library, go through all of these points. This is just another way for me to give you this information, and I believe, as a teacher, that if I give you the same information in different ways, one of the ways are going to resonate more. So this is just another way of thinking about this concept. So just go through this by yourself. Phase C, D, and E, and then your homework for next time. Your homework is still going to be on labeling. We're going to label Microsoft. And it's the same assignment. I want you to label the trading ranges with Wyckoff phases, events, and change of character. So let's quickly look at this. And you could notice that I don't have the volume signature on all of these slides. It's very intentional. I want your mind to think only about labeling at this point. So 1, 2, 3, 4, 5, 6, 7, 8, 9. Yes, okay, great. So 9 charts. Okay, so this is the homework. And then next class, what we're going to do is we're going to look at your distribution homework for today. And we're going to go through that, and we still have some of the material that we need to cover. But this is going to be our last final class on price structural analysis, and then we're going to transition into the supply and demand. Eric is saying here, too much, Ramon. Okay, well, yeah, if you guys are feeling like, for those of you who feel like, oh, it's a little bit too much, go at your own pace. Sometimes when I receive emails like this is a very intense course. Yes, it is. But there is no other way that I know how to teach this material, and there is no other way that I would want to teach this material. It's just me, it's just kind of like a teaching style. So therefore, take your time and go at your own pace. If you feel like you can't go through the whole homework, make it a point just to label at least 1 chart, maybe 2, maybe you can do 3. Maybe you'll find the time and label all 9. And obviously, it comes with the practice. So the more you practice, the faster you're going to see those concepts on the chart, the faster you're going to label those, and so on and so forth. So that's kind of like the key, to study, but to study at your own pace, and don't overdo something like this, where I understand that this is not your job. This is more of a secondary income that you want to create. Maybe it's kind of like a hobby for somebody. So therefore, just pace yourself. All right, let's see at some of the comments. What does it cost to be a part of your Wednesday market update class? Well, definitely go to our website. Let me just see if I could quickly. If I could quickly show you this. So under classes, go to market, Wyckoff market discussion. The cost of this class is $99 per month. This is a monthly recurring payments, so you can cancel it at any point via PayPal. or just email us. And this is an hour and a half on the market on the last bar. So yeah, you're welcome to join us. Another question. Roman, for me, the confusion is the difference of sign of weakness or sprain due to reaccumulation. Can have a sprain and distribution have sign of weakness so that it's so similar? Okay, let me rephrase this question so I think I understand it. So the difference between a sprain in the reaccumulation and a sign of weakness in the distribution. I'm going to assume that a major sign of weakness in the distribution. So what's the difference, right? Because they're going to look the same or somewhat the same. Well, there are quite a few things that are going to happen before, right? Even in phase A, as we've studied, there might be some like very average volume signature that's going to indicate to you that this is a reaccumulation. Maybe there is a subsequent supply dry out and maybe just slight increase, local increase of the volume signature on the actual spring. Whereas in the distribution, we might have phase A that's going to be associated with a big supply increase and then increase of the supply signature on the way down. So that could look different. But even if we have not noticed this, then we always would be thinking about the confirmation of those patterns, right? The confirmation of a spring, a confirmation of a sign of weakness. So what would be a confirmation of a spring? The price comes back into the trading range and goes into a major sign of strength. And then with the major sign of weakness, there's going to be an attempt to come back. The price could come back, but then it still needs to react into the resistance and then collapse. So those are going to be two different pictures that you're going to see as a confirmation. So I would concentrate on that first because it's an easy identification, and then try to define the buys throughout the whole structure as you go through phases A and B, which is a much, much harder task. All right. Is there a redistribution trading range setup similar to reaccumulation, or will it just precede by buying climax during overall downtrend? There are quite a few similarities that we could have between a reaccumulation and a distribution. And usually, as we say, like the first 1/3 of the trading range is going to look the same. Now, this statement is correct and erroneous at the same time, because yes, in some instances, the trading ranges are going to, with different bias, with the reaccumulation and the distribution bias, indeed, they're going to start the same way. And actually, I have an exercise for you for the second month where we're going to look at something like that. And yet, the resolution of these trading ranges are going to be different. So we'll talk about that difference more. But on a very kind of like simplistic level, yes, you're going to see distributional patterns that are going to look a lot like an accumulation, or reaccumulation rather. I've started session number 1 with the examples of the trades that I made. Go back to that session and rewatch a trade in Navadia. I've mentioned to you that throughout the whole trading range, this was one of the leadership stocks that was on my watch list still as a reaccumulation. And I don't think I don't see anything wrong with that definition. Yes, we know that Navadia went down, and it would be dishonest for me to tell you that I was thinking of the distribution all the way through the trading range. That's just not how I function. I was thinking about the reaccumulation, so I'm going to tell you this. And then some elements that came later on after the upthrust that suggested the change of character and defined the bias to the downside. And that's when I figured out that now it's going to be distributed, and it's going to be distributed, relatively fast. So we're looking for those type of the definitions. Whenever you're asking me a question like that, you're looking for a linear solution to a complex multivariable type of problem. And you can't solve this problem in a linear way. Or you can solve it in a linear way, but you have to have the capacity to connect so many different variables, so many data points, and you just can't. As a human, you can't. I think that, if you're using maybe like supercomputers, you probably can, but you still have to define the rules even for the supercomputer, unless you define the artificial intelligence rules, and then the system learns how to identify it. But for now, the key is concentrate on the concepts, and then be fluid, be dynamic in your analysis. Don't be linear. Don't be thinking that, it has to be all rule-based. Yes, it has to be, but in a lot of cases, it has to be conceptually based, concept-based, right? So concept comes as a change of character, bias changes, and therefore a good trade is being produced. Okay, what else? Okay, so I'm just gonna conclude here with one last remark, and that's it. I'm gonna go on the rest. This comes from Rick, and he says, "No other way I would want to learn. This is my life to trade. This is my job." And I love this because I'm the same way. You guys could definitely feel this, with each session that. I've developed quite a passion for trading, for markets, for this material, the way how the logic works with all of those details and so on and so forth. And I definitely know that there are quite a few people in this class who has the same passion, the same kind of like dedication, commitment to this material, which is great. But I also do not want to oversee other students who maybe do not have, the same amount of time and the same type of commitment just because of how the life is, right? There are other things, more important things than this even. There are families, there are jobs, there are other things that responsible for. So totally get this. Do not stress about that at all. And go at your own pace. The key is just to stay in this system, right? To stay in this educational system and try to get the most value out of this education. So therefore, come to the class, be present, be conscious when you are in this class. This is one thing that when you come to this class and you're tired and your time is limited, do yourself a favor. Stay conscious for this 2.5 hours and stay present because you're going to gain a lot of knowledge and you're going to gain a lot of material from this. But if you're not paying attention, then it's kind of like, you're there, but you're not there. And then if you can't rewatch the video again, that's fine. If you can't do the homework fully, that's fine as well. Maybe in the future you could re-listen to the course, rewatch the course, and do those homeworks. So I've been teaching for quite some time, and at the beginning of my teaching career, I was, so strict with students, and then it took me, a time to understand that people have, their own lives, and there are some things that are much more important than this. So define your commitment and involvement in this course by yourself. Let me know how you're doing this. And I support you all the way with whatever path you choose. With these guys, I'm going to say good night. I'm going to try to post this recording tonight. And then I'll see you all next week on Monday. Send me your homeworks. Thank you, guys. And I'll talk to you later. Cameron, thank you so much. Bye-bye.